Hi, I hope this video finds you in best of your health. This is Ritika and we are doing CFA Level 1 Alternative Investments. This is the only reading under this study session called Introduction to Alternative Investments. This is LOSC. In this video, we have to describe the potential benefits of alternative investments in context of portfolio management. So let us begin. Here are some of the benefits of investing in alternative investments. The first and the foremost is it provides alpha returns. So the most important and fundamental principle that guides all the investment in alternative assets is that these markets are inefficient and offer positive alpha returns. Now what are alpha returns? Alpha returns are the real risk-adjusted returns. It is the excess return over expected returns. The alternative assets thus require active management in order to generate positive alpha returns, and thus the alternative assets act as return enhancer and portfolio diversifier. There are, however, certain challenges towards investing in alternative assets. Some of them are finding reliable measures of risk and return, identifying the appropriate allocation, selecting the right portfolio managers, etc. But they are usually compensated by the returns these investments offer, which are really high. The second important benefit of investing in alternative investment is that they provide diversification benefit. So now you have more than just traditional investment in your portfolio. Most of the alternative assets have low to zero correlation with traditional investments. This can be evidently seen by calculating the coefficient of correlation between the historical data of both categories of investment. They therefore provide diversification benefits to the portfolio. The main reason behind the low degree of correlation is that alpha of any asset is generally not correlated to its beta. And the third benefit of investing in alternative investments is the amount of returns that it has to offer in comparison to traditional investments. Most categories of alternative investments offer a higher return, therefore they increase the returns on the portfolio. The main reasons for higher returns on alternative investments are the tax benefit involved with investing in alternative assets, higher management capability due to requirement of active management, higher return premium for illiquidity, and use of leverage. Now a couple of questions for a quick revision. The first one says, alternative investment funds are typically managed A. actively, B. to generate a positive beta return, C. assuming that markets are efficient. We discussed this just now, and it's A, the active management. Now moving on to the next question. An investor is most likely to consider adding alternative investment to a traditional investment portfolio because A, because of their historically higher returns, B, because of historically lower standard deviation of returns, or C, their inclusion is expected to reduce the portfolio's Sharpe ratio. This is also fairly simple. We have just discussed alternative investments offer higher return in comparison to traditional investment. So option A is correct. So this was LOSC. If you have any questions, contact us. Link is in the description. We will get back to you as soon as we can. Practice more problems on this topic. Again, the link is in the description. Subscribe for more videos related to CFA Level 1.